And I think that potentially is the next huge draft up. Like, again, at the beginning, I said, I think the next few years are going to be more reminiscent of the most recent years that we had. One caveat to that is if that narrative that I talked about comes to fruition, that's where you're going to see that leap from 10,000 to 100,000 or something even a little bit more. And it's because of now this speculative frenzy is being driven by really deep pockets because they're like, crap, I've got to fill these unfunded liabilities now because boomers aren't getting any younger.
Layer 1 is a podcast and community dedicated to helping you master all things crypto. We'll be bringing you the best interviews with project executives, technical analysis for trading of the most popular cryptocurrencies, and insight into what's actually happening behind the scenes.
As you join us each episode, you're going to hear about tokens, fundraisers, investments, and even crypto conspiracies. But please remember that nothing we say should be considered financial or legal advice.
Come join us on this journey and welcome to Layer 1.
Alrighty, everybody, we are back with yet another Layer 1 podcast for you. As always, a super interesting guest. As always, lots happening in the markets these days. This is going to be more of a investing or trading oriented podcast. We're going to talk about the oil collapse yesterday and in a unique kind of setup now. Instead of Q, I'm here with my main man, Dimitri. So how you doing, Dimitri?
Yeah, what's going on, man? We're switching up the duo here, so I'm pretty excited to do this one with Mike. We obviously have an exciting guest today, and I'm excited about the topics we're going to talk about because it's all about trading and the things that are going on in the market right now. Like you mentioned, oil, which is crazy. So who do we got today, Mike?
Yeah, it's going to be a good one. So we have Christopher Brookins from Valiendero Digital Assets. He runs that fund. Chris, how you doing today?
I'm doing pretty well, thanks. How are you doing?
Doing well. It's like we were saying, more crazy days in the markets, whether it's crypto or traditional markets. We were joking yesterday, I think it was during the live episode that we do under the Layer 1 podcast about, hey, it's nice for once that crypto isn't collapsing and it's another market that we don't trade in that's collapsing. So at least there's that silver lining around what is obviously a pretty crazy scenario. But as is tradition, before we get to oil or crypto markets or even Valiendero, we want to learn a little bit more about yourself, right? So kind of what your life and career looked like before Valiendero and how you got into crypto originally.
For sure. So my experience primarily is within finance. So a little bit polymath, ranging from equity trading to debt investing to relationship management. About midway through my career, I realized I didn't want to be a finance hack for my entire career. Surprise, surprise, I'm back within, finance. So I wanted to go back and get my graduate degree. Being from Pittsburgh here, I matriculated to Carnegie Mellon because I wanted to get involved. I wanted to beef up my data analytics skills because I knew that's the way the world was going. But also I wanted to get involved with high growth technology startups. And CMU is really renowned for that. I wanted to figure out whether or not I actually wanted to be an entrepreneur or I just was in love with the idea of being an entrepreneur. And I figured no better testing ground than that area. So I succeeded. I was able to get linked up with a data analytics startup that was based out in San Francisco. One of their early employees, at that stage, you're doing a lot of product, you're doing some business development and stuff like that. Was fortunate enough to work with them for a little while. The company was acquired at the beginning of 2018. Throughout that time, I was keeping my eye on what was happening in blockchain. But as the popularity, grew and grew and grew, sort of culminating in 2017, it made me want to, essentially switch and go full time into that particular space. At that time, a former partner and I, we were kind of doing almost like a syndicated investment firm / research called Sutler Ventures, really with a primary focus on fintech, which gradually went more and more towards the blockchain side again, because it was kind of in that 2017 sphere. And then you saw the run up happening, and myself having that background in data analytics now from CMU, it made me think like, okay, like clearly this is going to crash, and crash it did. But it's like, okay, if we know if we could see that anecdotally, is there a way to be able to spot that with data? And then furthermore, if you look at the traditional markets, they're dominated by some sort of algorithmic strategy or quantitative strategy, to say the least, whether that's front running, high frequency, whatever it may be. So if I'm bullish on this market and this asset class long term, which I am, it wasn't that big of sort of a leap to presume that quantitative automated strategies will have a more and more influence within this particular market. So my good friend, he's an advisor still to the fund. He leads up the graduate program at the statistics school at Carnegie Mellon, and essentially just posed the question to him, like, do you think we could do this? If so, are there PhD students that you're currently working with that might be interested in, to be able to, see whether or not we could actually solve this and validate my hypothesis, but also at the same exact time get access to top level talent before they actually hit the open market. So fast forward, 15 plus months of essentially just experimenting, we finally got to the stage where we're like, yes, we have something. And from that particular genesis, we stood up Valiendero. I stood down Pugilist. We built out the trading system. We debugged, trading with our own capital for a little while, and then the fund has been live since September of 2019. And in general, doing on its promise or executing on its promise that we put out to investors, which is essentially being a hedge to the overall negative volatility of the digital asset space, while still giving LPs the opportunity or exposure to the outsized returns opportunities. And we typically do that through machine learning and some other mathematical data first approaches. So that is, kind of how my background took me from where I was and then ultimately dragged me into crypto, because it kind of intersected with everything that I had done professionally, but also interest wise as well. And furthermore, these days, given, whenever I was an undergrad, I really was deep into macroeconomics. And now, given the sort of guillotine hanging over all the markets and general economy's head, I've had to sort of like dust off those caps and even go to my bookshelf and start pulling out, economic history books to kind of figure out where the additional exogenous shock can come from that our models might not necessarily be able to anticipate, given it's only got 10 years of data. And really, probably, we posit that the data since 2018 is really the only usable data, given, we suspect that the future will look more like the most recent years versus like the go-go years where people were making, 100,000x, on their original investments whenever they're in the early days. I don't suspect that those days are back. I'd welcome them, given we're in the space, we make a lot of money, but I don't think it's prudent to sort of, especially from a data first perspective, to look at it from that particular line of logic.
Yeah, and there's obviously a lot there, right? I definitely want to break into the point about the efficacy of data or the value of data, even if it's 10 years or 2 years there. I want to talk about how algos and bots and all basically the different quant strategies that are starting to move into the space could affect it. But for those who don't have that finance background or don't have that data-driven background, right? Can you just break down at a high level maybe the way that a Valiendero type, a really quant fund in the same way a Strix Leviathan quant fund, which was another guest we had on the podcast last week. How does this more data-driven quant fund interact in the market versus your typical kind of buy and hold, right? Where maybe the buy and hold does a lot of fundamental research around, hey, what's the potential that this project or this token or this layer one protocol is able to pull value and increase in price, right? It's very much a long only strategy, whereas this is not necessarily the case. So can you kind of break that down at a high level as to what those main differences are for those who maybe don't have that background?
For sure. I think it's a great point as well. So from my particular perspective, there's probably about like three main strategies that kind of dominate the investment management space within digital assets. So you've got sort of what you're talking about, like a very venture capital type perspective with fundamentals, where people are like, hey, I think Tezos or, Chainlink is going to be the next big protocol and fit this use case. I love the technology. I love the founders. I think it's going to be awesome. So I'm going to hold, I'm going to buy in equity whenever you can, and then I'm going to hold these tokens for it for the next 5-10 years under a liquid guise if there's tokens there as well, which is where it gets a little bit interesting whenever those funds get marked to market, because you're essentially taking an illiquid investment strategy, but then you have a liquid token associated with it. So I'm not in that. I'd be curious like to see how that like resonates with LPs. Presumably they're of the same mindset, but you've got a very like strictly capital type perspective in this market. And then another sort of like offshoot of that kind of mentality is what you would like see the Bitcoin and the Ethereum armies, or even the XRP armies for that particular matter, where it's like Bitcoin is going to be the next alternative store of value. It's going to displace gold. It's going to, you know, bring down fiat regimes and blah, blah, blah. And then you got Ethereum. It's going to be the world's computer for everything ranging from the new financial order to, you know, X, Y, and Z. And then XRP, people believe XRP is going to be whatever for whatever reason. But you've got those, you know, sort of groups or investment groups that believe in it and hold it for the long term, and they tell their, you know, their limited partners. Grayscale is a great example of that, where they just have trust. They essentially buy Bitcoin in the open market and then repackage it in an investment vehicle that is readily accessible through standards to what's it called, or to accredited investors, but also through their financial advisors that would say, hey, maybe this will help balance out your risk reward profile of your overall portfolio. They're not reinventing the world. They're literally just essentially taking asset A, repackaging an asset B, because they know it's going to be more palatable and fit within their particular parameters that is going to be able to, you know, draw down on some of those institutional capital people. That's a great example of the fundamental players where they're like, hey, we think Bitcoin is going to be good, Ethereum too, and essentially whatever they have in their Grayscale trusts. And then you come over to our world, the quant world, where that again is broken down into these different sub-segments and categories, where what you're seeing now a lot, at least from my talking to people, is market making, whether it's in illiquids or even in some a little bit more liquids. But I think that's getting gradually taken over and more by the bigger guys, where market making, because the infrastructure within this space is not nascent, it's growing, it's getting better, but it's a level playing field. So, you know, on the NYSE or NASDAQ, again, I'm not an expert in it, but there's people, you know, Goldman Sachs and all these companies are paying huge millions of dollars to be able to get their machines closer to the execution, to be able to front run and essentially get speed of execution in nanoseconds. Bitcoin, you know, the crypto markets don't have that infrastructure, so everything is readily sort of like fair and even playing ground. So that's why some of these like non-name brand market makers can actually compete and make money alongside with, you know, the Jump Capitals of the world or the DRWs, where if it were on, you know, traditional markets, they would get eaten up. So we're seeing a lot of people play in that particular space. There's still some arbitrage, but a lot of that has gone away. And then, I mean, market neutral strategies are really the big thing, which can be, you know, going long one particular asset, going short another one based upon some correlation or mean reversion strategies. And then there's kind of like what we do, which is less prevalent, which is directional bets, and strictly on 2 time frames. So we'll look at an intraday time frame. Normally it's a low to mid frequency, meaning we'll make on average, I don't know, maybe 15 to 20 trades per month per asset class that we would look at. So not high frequency by any stretch of the imagination. So we're not over trading. We're essentially looking for the right time to get in, to spot those local inflection points within the market data. And we do the same exact thing, just on a longer time frame, the longer term scale in this market, which is typically like 3 to 6 months. And we're backed by data and mathematical models that tell us like, okay, here is the probability of like 80% of whatever, that we're at a local inflection point for the next 6 months on the positive side. Let's build up a bigger position and kind of be like long-term holders, and then ride up the wave so that we're not constantly trading around it. And so the longer term strategy, like in a month like January in 2020, will do the heavy lifting for our returns. But then, you know, in March to April, our quant strategy is going to do the heavy lifting, because it's spotting those local inflection points through the downdrafts and then buying and selling and buying and selling. So that way we're able to kind of have a balanced portfolio, but it's all driven by mathematics. It's all driven by machine learning. And it's just something that we sort of iterated into this sort of directional quantitative strategy, again, through experimentation and just going where the data taught us to do. I didn't dump out of Two Sigma, Renaissance, or anything like that. So I never had that particular experience, or maybe I would be in the market making game as well. So we just kind of got to play with the cards that we got.
There's so many questions, but let's go through the data for example. There's lots of data out there, and the question is, how accurate is that data? So when you're using the data to make your calculations, on the quant side, how do you find data that is actually accurate? Because we've seen in crypto a lot of like spoof data in terms of volumes and a lot of other indicators that you traditionally use in traditional finance, but here they're overinflated and spoofed. So there's a lot of noise and distortion in the data, which can kind of negatively impact your quant strategies or machine learning. What are your thoughts on that?
Yeah, for sure. So, I mean, you hit the nail on the head. There's a lot of issues with data quality and just general like soft manipulation of said data. And, that's a persistent issue. And we're gradually moving more and more towards a situation where kind of like reputable indices, whether that's like a Brave New Coin liquid index or a Coin Metrics is now getting into the game a little bit, become more and more critical, because you can kind of reliably trust the data that you're getting, and also the volume data associated with that as well, given, they're stripping out, they've got their own methods for being able to strip out some of the, more nefarious spoofing and stuff like that that's involved. But for us, we do look at some of that data, but you kind of got to go to the best standard in practice, meaning like, I'm not going to build our models on like OKX or, Gate.io or even Bitfinex, and not to like slam those people. I don't want to get a lawsuit or anything, but there's like, we're a US based fund. So at least from my perspective as the founder of the fund, like I look at Coinbase or like a Kraken or even a Gemini kind of as a gold standard for quality of data. They're not going to have as much volume on them, versus like a Binance or anything like that. So there's some normalization that needs to be taken into consideration, but they're essentially, at least for right now, under the blessing of the US regulatory body. So, there's at least some frame of fair play associated on those exchanges. And they typically charge a premium for it in terms of fees versus some of the other ones where you kind of, there's a little bit of a trade-off there. So that's how we work around it in the here and now. From a data perspective, we'll only look at like quality, reputable exchanges to build our models or retrain our models on. But also, you've got to have a layer of margin of safety in the models as well. So we'll calibrate a lot of what we do based upon probability, and we'll flex that probability based upon the market conditions. So if we're in a bull market, we might say, okay, hey, algorithms, you need to be at least 60%, 65% confident that this is a buy signal, for Bitcoin, for you to be able to go ahead and make a buy decision or a sell decision. It goes both ways, but if it's a bear market, you might say, hey, algorithms, you need to be 75% confident or 80% confident that this is the right time to buy or sell. And we build those layers of flexibility within it because we realize that there's a certain level of massaging that needs to go on within this market to be a quantitative fund. In this market, there's got to be a margin of safety, and there's got to be a little massaging, given the data is noisy in and of itself, but then you add in, the reliability issues with it too, and then illiquidity in some areas, and you can get these wild volatility swings, or just, things that, volume that was spoofed and then goes away at the first sign of, friction or whatnot within the market. So there's always got to be a layer built in there. And that's how you can adjust for it, not on a data front, not just on a data front, but also on like, a technological front as well.
Yeah. And I think really what you're getting at with the discussion around data, and as well, this discussion around the really almost lack of categories that exist when investing in digital assets, is that this is still very much the wild, wild west, right? And what that means is that while there's going to be a lot of risk, right? There's going to be a lot of uncertainty. There's going to be infrastructure that needs built out. There's also going to be an immense amount of opportunity. whether it is on that venture side and you're able to get in early on equity, like say on a Coinbase or a Kraken type, or in early on a token like ETH via an ICO, right? Just amazing outsized returns that you're really not going to find anywhere else other than just bleeding edge tech, which, I would say even today, we still really find ourselves in. So as you guys are existing as a quant fund in this, basically wild, wild west, what happens and what kind of goes through your head when we have an event like a Mount Gox, or we have an event like we saw on March 12th, where, the equivalent metaphor is some outlaws basically run into town and shoot up the whole town, right? How do you kind of think through your models, taking into account what has happened and why it happened, especially if on like a March 12th, it's more of a systematic issue?
Yeah, I mean, so to your first thing that you're talking about is, for whatever reason, like investors always think that there's, or I guess humans in general think that there's like a free lunch, even though that's the first thing that you discuss in Econ 101. So it's like we can't have these nosebleed returns without having, nosebleed risk essentially. And it's like there's a reason why the returns are so high in this particular market. It's because it's really, really risky and really volatile for all the stuff that you talked about. So I mean, you hit the nail on the head there. So knowing that, at least being honest, like with yourself, which we are, knowing that you can start taking proactive measures to adjust for that, knowing that situations like March 12th are bound to happen. Did I ever anticipate that I would see Bitcoin drop, over 50% in one day? Definitely not. That's not something that you can like readily model, especially given it never has happened in the small historical sample set that we had for Bitcoin and some of these other digital assets as well. So you can't really model that. But what you can have is a robust risk management system, which we utilized again to build out the longer term strategy for us to be able to say, okay, we think, within a high probability, we're in a positive inflection point, a bull market essentially. And then it turns the same exact way. Whenever we get that signal, which we did at the end of February, early March, like, hey, things are starting to look like it's going to swing the other way, which I didn't anticipate. I thought this year was going to be quite bullish given the narrative around the halving. So, I mean, but I've got to look at the data and essentially go with our process. And it said, hey, things are not looking so good. So we were flexible enough to switch our settings, our algorithmic trading settings, to bear market from bull market, and then essentially go to cash with all the core holdings that we were able to do. So with that, we weren't affected at all really in the 12th. In all honesty, that's where we made a lot of our money, because we were buying, at the bottom because we were liquid enough to be able to do that. And also we stuck to our principles, knowing that like this is bad, but then the same exact time you get a huge downdraft and like, all right, there's still a guillotine over the market's neck, which I still believe, but there's always a gradual mean reversion, which you can play in with, respectable risk reward parameters. So you've got to have that built in, which we do. Like we're risk first. So again, like our goal for investors is to hedge the negative volatility, not be a part of it, so that, we can still have good years like we're having in 2017 without like needing to, have a 20% or 30% drawdown for a month. Like we leave that to the fundamental guys and the venture capital guys. So, which means we might underperform like in the go-go years, but our hypothesis is we'll outperform over the long term because we don't have to constantly claw back out of like a 30% downdraft for a month and stuff like that. So it comes down to like accepting what the market is, which is highly risky with, systemic issues that you saw with BitMEX, which I hope, which you're gradually seeing, like traders and people involved with it are like, this is actually really bad. So you're seeing more and more of like Bitcoin get withdrawn from BitMEX and reallocated to at least somewhat more reputable exchanges as well. But yeah, those are systemic issues that you can't really model for. And you just got to have a risk management approach in place to say, all right, if it goes past zero barrier, like we go to cash, or we completely hedge the portfolio, or whatever it is. Like we're not just going to ride it up. And I send my investor letter, to LPs, and they're like, hey, don't worry, we're in it for the long run. We're down 70%, but like that's not a conversation I really ever want to have. So yeah, that's kind of how we go about the general structural deficiencies, I would say, of this market.
I see. So, that's a pretty wild story, all things being considered. Obviously, you look back on March 12th, and I think it's really easy for a lot of people to say like, oh yeah, there was so much open interest, right? Of course it's, BitMEX is shady, right? Of course this happened. But as it was happening, as all of this fallout was occurring alongside the traditional stock market, obviously it was a crazy time, right? It was probably the craziest day I've seen in the 5+ years that I've been in the space. So just on your side, right? As someone who's the founder of this fund, from that period that you guys got that signal, at which point it was, things were popping up with the coronavirus, but we were still relatively bullish. I think, as you said, people were pretty excited with the halving coming up only a few months away, and things were trending up from a price standpoint. But to make that decision, right, to follow the data, all things considered, like I said, with the halving, to then basically come out unscathed and make money on top of that during that Black Thursday event. What was kind of going through your head throughout that process and then on the 12th?
Honestly, man, that was a really, really wild week. It affected me and like my family as well. Cause like I went to go see my new niece and down in Kentucky, literally the day after March 12th. So it was like March 13th, and I was not in the right mind space to be around family.
Sure.
And like, I definitely hurt some feelings, but that was a wild, wild week because of like all the conflicting signals that we were seeing. So like for me, that was like an amazing lesson where it's like pressure makes diamonds, where the old adage, it's like no great sailors were ever made, with smooth seas. And we're better because of it. Are we a little bit more like less gun shy because of it? Heck yeah. We definitely didn't make as much money as we could have over these past, I would say, 4-week period that we've gotten a run up. It's because we had that experience and like got it right, but also took that to heart. Like that could have been really, really bad. You saw a lot of funds with like name brand individuals essentially, closing up shop saying March 12th crushed them. So it was really wild for us, precisely because of all the conflicting signals. But once that like zero barrier was hit for me, which was one of the technical signals. So not only do we look at one metric called Hurst exponent, where that moved into an area where it's like, okay, there's risk abound, but then, we were even still like hanging in there until around like 8,000. So you figure, pull back from, 10.5 to 8,000, and we're still like, no, that's a healthy retrace. But once it dropped through there, like we knew something was completely different. Like it's no longer a bull market, it's a bear market. And we went out. We're able to look at that situation rationally and logically because we were out and we were sticking to our guns as to like the process. And because of that, we were able to make money on it. If I was sitting there still holding the bag, I would not have been able to sit there like logically and make the appropriate decisions, because there's still a little bit of a human overlay. We're a quant fund and a lot of what we do is automated, but there's still a human overlay. So if the human behind it is compromised mentally, then I'm not going to be making good decisions for the fund, which is why like once I said, all right, boom, it's done, like the structure has changed, it felt like a weight off of my chest, and then we're able to make the appropriate decisions. But that week was really, really crazy. I kind of hope we don't, like, even though that's where we made a lot of money, I kind of hope we don't see that again. But again, we're starting to pick up additional signals where we're like, this we might not be out of the woods just yet.
Yeah, absolutely. It was definitely a crazy week. One thing that I really agree with you on that side, where you talk about how traders are now deciding which platform to go with when it comes to executing their trades, especially when you have BitMEX that has been around for some time and has been dominating that scene, but they're now starting to screw up and and people are seeing some problems in terms of systematic issues, execution, all these things. Like XRP, like when they first listed it, that thing like dropped like, for just a second, like 90% or something, and liquidated everybody. And they just came out saying that, hey, this is just a liquidation engine, or like this is the execution engine and it's working fine. So absolutely, like reputation now is, for BitMEX is kind of going down. And overall, I think, coming from traditional trading side, I think a lot of, traders right now in crypto, they don't really look at execution quality and all these things that, we generally look at on the traditional side for in finance. So I think it's good for, even though that event was crazy, right, and quite negative, but the silver lining is that there's a lot of positivity that comes out from it, where maybe certain platforms will start competing for that market share to get the traders, because they have better execution and all those things that go with it during especially high volatility. So my question that I want to ask, for those that are listening, that are just regular traders, not quants, how are these bots and algorithmic traders, how are they going to impact those that are trading just regularly? Is it going to be bad for them? Does it mean that the algos are going to take lunch from the retail guys that are trading, or is it actually beneficial?
So like, first off, I think you're in point on everything in terms of like what happened with BitMEX. It's kind of like the self-governing thing. So like, yes, crypto and digital assets are the Wild West still, but like you're seeing these free market properties like play out where it's like, oh, if we actually don't take care of what we have, like this will go bye-bye like really, really quickly. Whether it's our own destruction or regulators come in and essentially just crush it. So I think that's what's actually really good about this space is people, yes, there'll be some bad actors, but then people will come in and say, no, we need to put this on the straight and narrow, or else everything that we've been working for over the past 10 years that a lot of people, myself included, have staked their careers on will be gone, in a split second. So I totally agree with you. And I think you're gradually seeing investors and funds vote with their feet, moving away from some of the less stringent exchanges, so to speak, which they might have an opportunity to change and win back the loyalty. To your question, I think it cuts both ways, because the market, again, there's not a lot of liquidity associated with it. So that's a lot of times why you see these volatile moves, which makes the data like really, really noisy. So again, we have to take like risk management approaches, but also we've got to take like these massaging approaches just to be able to fit the data, or fit our models to the data structure, where we can actually make money associated with it as well. So I think it's probably about a 50-50, where given there's more algorithmic and quantitative strategies entering the space, you'll see that at the expense of retail investors. But also there's a certain layer within this market, specifically whenever you start getting down, the top 20s, the top 30s, top 50s, top 100s, it's going to be real difficult for a quant fund to really fit any, models to that. So potentially in the longer term, you'll see more retail get pushed to those particular areas, which might not necessarily be a bad thing. If they can pick correct, it just becomes more of a venture capital where, 90% are going to go to zero, but the 10% might, completely go 100x and pay for all their losers. But, in the interim, I think there's a space still for both, where people like myself are coming in at the expense of other quant funds, maybe other fundamentals, people with different time preferences with retail, but there's still a lot of moves that is going to be a lot better handled by a human than an algorithm. And March 12th is a great example there. Again, we're looking at data, but ultimately it's the human behind it. And furthermore, if the market starts going by a big clip, we've got an automatic like tripwire built into the system where the algos stop trading. Because if the market drops 10%, it's just going to be buying dead cat balances the entire time, because it's saying, oh, there's a great time to buy. Like, heck yeah. But it's not, but like a human can see that this is a trap, but like an algorithm cannot see it. So that's an additional like safety measure that we build in, like knowing, because I've seen the data over and over again, that like, oh, this is actually not a positive thing that we got to do. So with that being said, there is a human behind it sometimes, like keeping the technologies, the robots out of trouble, which is why I think, there's a space for both right now. How that relationship evolves over time, we'll just have to wait to see. It comes down to, will the space grow? Will more institutional money come into it, get involved and stuff like that, to where it might push more retail traders to some of the illiquids, but that might not necessarily be a bad thing.
Yeah, I mean, I would even say that most retail traders, especially those that kind of lack a lot of sophistication, maybe they're not futures traders, right? And they stick to spot, which is kind of where I started. That's where they've made the most money, right? Just kind of getting in on a token early and betting that it was going to see some sort of growth, whether it was in growth in reality or growth just out of pure kind of speculation and potential and marketing in these things. So I would definitely tend to agree there. Speaking on March 12th, this was obviously a time in crypto that coincided with a lot of chaos in the traditional market. And in the traditional market, I think it's pretty clear to most that what we really saw in a giant drop down. I mean, we had multiple double-digit negative days in the traditional stock market. And that's obviously not something you see, right? And this was really occurring because there was a flight to cash. Anybody that was over levered in any way were just going to get crushed. And for that reason, you had basically a lot of people taking positions like maybe in say gold, for example, right? Something you want to have in a recessionary, in an uncertain time. They were taking those positions in order to supplement margin to positions that maybe we're getting irrationally crushed because of all this chaos. And when you look at crypto around the same time frame, everyone points to BitMEX and I think points to a lot of institutional money selling their Bitcoin and getting out of the space in order to support some of those more traditional levered margin plays, right? Those where they needed to supplement that margin, basically. Do you think that's the case, or do you think it was really more purely systematic and there was just not enough, buy support or liquidity on BitMEX, and we haven't really seen as much of an institutional flock from crypto?
I think so. It's tough to say. And like, again, one of the issues within this space is, yes, it's way more transparent than probably your traditional asset class, because, equities or anything like that, given, transactions that are out, it's broadcast over a public ledger, over a public blockchain that you can track. You don't know the information, and nor do you know the motives behind it. So it's really tough to tell like what's going on, but there is a layer of transparency that is better than traditional markets. With that being said, I think it's conceivable that narrative makes sense. So I even wrote about it in my weekly newsletter, to investors, I don't know, over a month ago, like talking about that, saying no one knows because they just don't. But that narrative conceivably makes sense, given at that time, like the big news was oil was gonna open up. Once oil futures started trading on Sunday, oil was gonna open up like down, what was it, 25% or like 50% or something, which was insane. Which whenever the S&P futures started opening up trading on Sunday, or at least pre-market, it was pointing to an absolute bloodbath. It was limit down. So it's conceivable to see, like, after those consecutive days of bloodbath, that institutional investors that maybe would have dipped their toe in Bitcoin are like, all right, we need to lock in gains, essentially. I forget the theory called of it, but investors will lock in gains so to finance their losers. And they're saying like, all right, we're in Bitcoin, we're up, let's lock in. Monday is going to be bad. We're probably going to get a margin call. Like, let's raise cash and then see how we can get through it. So I think that narrative actually makes a lot of sense. I think that's what started it. But once we get past a certain layer or a certain level in crypto, you've got speculators piling in, and then bots piling in, and driving it down further. And then once it gets past an additional layer, then we start having systematic issues. There's no reason that Bitcoin should have dropped over 50% in 24 hours. So I think it started conceivably by institutions looking to raise cash to finance their losers, margin calls, whatever it may be in the market. But ultimately, it was our own doing, where speculators came in, took some easy cash, pushed it down more. And then we probably just hit a threshold where, systematic issues on BitMEX and maybe even some of the other exchanges just drove it down further and further and further. So yeah, I think that how I look at it and replay the tape, that's the most logical explanation for some of the things that happened, which is good, because we're starting to see some of that get corrected, but also it's bad because I could see that happening again, given again what's happening with oil, potentially dragging the overall market down a little bit as well.
Yeah, no, absolutely. And, it's interesting to see how the issue with BitMEX translates into the spot market and the other exchanges, and basically drags, the overall market price for Bitcoin to go lower. I wanted to ask, like in traditional finance, there's things like, circuit breakers, seat belts, and so on, right? So during, if we think that this might happen again, would something like this help crypto if we had exchanges that would have seatbelt circuit breakers where it just stops altogether? We kind of seen that on BitMEX, right? They shut down trading, and then kind of things calm down, and there was arb opportunities that were available between BitMEX pricing and what was in other exchanges. So how do if we do hit similar type of event, how do we what's the remedy for these systematic issues that might occur again?
So I think it's probably two-pronged. I think the seatbelt scenario is actually beneficial. So there's a reason why that the NYSE and NASDAQ have these types of situations. It will it will affect me, because again, in theory, if we're still doing our jobs well, we're going to benefit from those dislocations that make absolutely no sense. You're talking 4, 5, 6, 7 sigma events, which it's like, all right, maybe even we take a little bit of a drawdown of 5-10% while it's still clearing, but we know we're going to make it back. And that's exactly what you saw happen in the most recent one. So selfishly, it's like, okay, if we're doing our jobs, no, we don't want that to happen, because that could potentially, be removing a area of opportunity for alpha for us. But from a long-term perspective and sustainability of the ecosystem, for sure, I think that's something that needs to happen. And also exchanges self-governing needs to happen as well, not just seatbelts, but also reliability of data sourcing. I can't remember if it was a Chinese exchange, I believe, that is like instituting, I'm forgetting the name, but it's essentially an algorithm. Yeah, an algorithm to spot, manipulative behavior. So I think stuff like that, being proactive on that, is critical, so that you don't have whales, dumping on one exchange because they've got a bunch of shorts on BitMEX and then covering, and essentially a lot of the stories that you've been able to hear. So self-regulating with a lot of those proactive measures, seeing more and more exchanges do that, potentially with seatbelts and like circuit breakers and stuff like that, will only increase the sustainability and also the sort of the image of crypto, to try to drag more and more of these institutional investors within the space, if not more retail investors in this space, to be able to increase demand.
Yeah, for sure. I mean, I think it puts up a flag, like you said, for those institutional folks to say, okay, things are maturing, right? I see all of the opportunity in the space. Now I feel comfortable enough to put other people's money up, in an effort to generate alpha, basically, in this brand new asset class. On that note, we talked yesterday on the live episode that we do every week on Mondays, called Layer 1 Live, about the news that broke last week around Renaissance Technologies and some of the things that they're looking at in the crypto market. So if you hadn't heard, in one of their quarterly filings or monthly filings, the Form ADV that they have to put out, there was a small paragraph about the ability for their medallion fund, which is the fund that only manages their internal money that their employees have put into it over many decades, will now have the ability to basically use Bitcoin futures to generate alpha. We had a discussion back and forth about what this could potentially mean. As someone who exists in the quant space, right? Obviously, Rentech is kind of the god of quant funds, right? And one that everybody looks to. What do you see as the reason for them potentially dipping their toes in? One side of the discussion was, perhaps there are some folks there who just want to kind of go long Bitcoin, and maybe this medallion fund is a good way to throw a little bit of cash in. As you said earlier, it's great asymmetric returns. It's not super correlated to the rest of the market. Maybe they can spin that in some way, even as a quant fund. And the other side of the coin, the argument to that would be, no, they are actually, looking at jumping in some sort of larger structured way. So where do you kind of fall on understanding what you understand about Rentech and obviously your context as a quant fund in crypto?
Yeah, I mean, those guys are the top. So you look at those, and from our perspective, it's like it's great news, but ultimately we would never want to compete with Renaissance, because it's just kind of like a fool's errand. From my understanding, or at least my intuition of reading between the lines, I think it's just like putting a soft feeler out there. I suspect that a lot of employees, much like a lot of finance companies, they're trading Bitcoin or buying Bitcoin on their own time. They're not able to do it within their companies for regulatory reasons. But given it's trading its own capital, the Medallion Fund, there's a way for to gradually dip your toes in. So I think probably some of the employees have already been trading in it and maybe think that they've got like some ability to fit some of the work models or algorithms to the data, and essentially just opening up that particular optionality to be able to trade in it. I think they look at that because of the huge outsize return opportunities. So and where ultimately it looks like fiscal and monetary policy is going. So I don't think they're like jumping in and saying, hey, we're going long Bitcoin and they're going to allocate $1 billion of the portfolio to it. I think people who think that like Renaissance is really going bullish on it are quite naive. I think they're looking at it strictly from a trading perspective, from the outsized returns, and also like maybe an optionality if Bitcoin does gain traction and starts to displace gold and start, especially if the value of the US dollar really starts to depreciate over, the short, medium, or long term. They want to have some kind of domain experience within it, especially if this asset class starts to grow and attracting more and more institutional investors, so that whenever the time's right, they're not starting from zero. They've already probably have some sort of like working model, working knowledge, learning curve within it. So I think that's what's going on. What's going to be tricky for them is the model structure, like I talked about, or I'm sorry, the data structure. It's crazy, like it's crazy noisy. So I'll never pretend to be better than those guys. So if I can figure it out, I'm sure they'll be able to figure it out if they like try hard enough and they've got a lot more resources than we have. But the CME, the liquidity on it is not great. So any exchanges that are blessed by the US regulatory bodies, the exchanges are quite awful. So I don't think they're going to be able to actually trade or move any like remote amount of significant volume that actually would move the needle for them. So again, they might just be playing around to, get their feet wet so that whenever the time's right, if and when it does happen, their learning curve is dramatically decreased. But if they're just going to go on CME, there's not a lot of liquidity there. So yeah.
Yeah, absolutely. You bring up a great point about liquidity and the limited liquidity that we have with regulated entities in the US, where, outside there's, quite a bit of liquidity and the volume that we see from different exchanges. So what would, what are your thoughts on like, how would the fund position themselves to have sufficient access to liquidity, maybe for Rentech or just regular fund that wants to access liquidity that's sufficient, that's not limiting itself to, let's say, just US regulated ones? Are there solutions where you can aggregate liquidity from different exchanges and route your orders this way, or are you kind of stuck in just in with the liquidity that's available in the US for Bitcoin?
So like for us, our particular perspective, we use like US regulated or or US based like quasi prime brokers. So we use SoFox is one of the ones. We originally started going from exchange to exchange. So it's like, okay, we want to trade on Coinbase, we want to trade on Kraken, and so forth down the line. And we would just build up the capabilities to be able to do that. Since then, we pivoted to going through some of these like prime brokers, just given they've got that's what they do. That's their entire business model. So it's like, let's not try to recreate things that won't necessarily move the needle in terms of alpha for us. So we do that. Longer term, especially as our fund continues to grow, or even talking from a hypothetical perspective for like Rentech or something, having global prime brokers that'll give you access not only to OTC to be able to move bigger volumes or futures or different exchanges that are domiciled all over the world. If you could do that through one or two primary prime brokers, you'll be able to source a lot more liquidity. Again, it's not going to be nearly as much liquidity as a huge or a massive fund like Rentech would need, but for a big fund within this particular space, it would allow them the sufficient liquidity they would need to grow and scale with not only compounding their assets from performance, but also attracting additional investors kind of linearly as the market capabilities grow as well. Presumably the infrastructure gets better, more liquidity gets attracted, whether that's institution or additional retail players.
Yeah, there seem to be quite a few, financial first crypto folks exploring the prime brokerage route. Dimitri and I have had this conversation, I think, off air before about kind of the viability of prime brokers in the space. And while I think that there's definitely a lot of benefit around collecting that liquidity on a global scale, and essentially as a fund kind of outsourcing the risk to somebody who is federally regulated and has obviously a significant amount of capital under them and experience, right? They have the context to understand which players are the good players, which ones have the real liquidity, right? And thus they're going to source from those folks. But I guess my argument against it, or at least my devil's advocate play that I would take, is that crypto has really, even with the institutional love that we're starting to see, always been a retail first or kind of a mom and pop asset market, if you will, right? It's denominated by holders. It's denominated by people who don't have, say, a financial background, but have more of a belief in an alternative financial system, or have some sort of development or computer science background. And unlike the traditional markets, at least as of today, there isn't a lot of regulation that prohibits these folks from logging onto a Coinbase on their mobile app, or hitting up a BitMEX or a Bitfinex with a VPN or whatever the case may be, and just buying their Bitcoin directly and moving it to cold storage. So you guys are participating with a prime broker, SFox, like you said. What is kind of the overall feel around prime brokerage in crypto right now? And did March 12th, have any effect on that negatively?
I don't know, in all honesty. Like, that's one of the areas that we are really that I thought was really interesting as well. But like yourself, it's got its own particular hurdles or whatnot that it might need to pass. Principally, it's going to live and die by being able to attract more sophisticated investors to this particular asset class, just like you're talking about. So I think you're 100% correct that if that sort of matriculation doesn't happen, then the prime broker business model is probably not going to be overly viable in the long term. But in terms of kind of like the effect of March 12th on it, I don't know. It seems, we haven't had any issues with our particular prime broker. They've actually been increasing different functionalities and capabilities. Obviously, those are probably already within the product roadmap pipeline. But we haven't heard anything through our particular network or even rumors on the street that any of the prime brokers have really been having issues as a result to that. I think the primary people that got sort of wiped on that were the ones playing within the future space, particularly within BitMEX and stuff like that.
Right. Yeah, no, that makes sense. And on the institutional front, I guess post March 12th, my biggest question has been, how does the narrative change? The narrative not necessarily being the core, hey, Bitcoin is an alternative choice, right, to big banks and corrupt government and the giant financial market that we see ourselves in, that has its problems and has its cracks, like we saw with oil, right? But really the narrative that has been pitched to institutional folks, which I think a lot of kind of talking heads, if you will, within the space have done a good job of garnering interest towards, especially that digital gold narrative, right? Post this, kind of recessionary start, if you will, do you see Bitcoin still being able to hold on to a narrative that institutional folks will find sexy or find appealing, and thus garner some of that interest, whether it's whether it has some sort of ripple effect to prime brokers or just generally the Bitcoin price or amount of general adoption to Bitcoin, or has that fundamentally been shattered now that we saw Bitcoin drop by over 50% in one day?
I think so. In the short term, I think it's going to hurt the narrative, and because I think just like you're talking about, a lot of these talking heads, but also people that just buy into them. And in all honesty, anyone that like really bought into the fact that they thought, Bitcoin was going to be a store of value that investors were just going to run to in droves today was incredibly naive. I understand why, talking heads and some of the investors or fund managers from larger funds would be doing that and trying to sell it to family offices and other institutions and stuff like that, because it directly affects them. Those are that's the capital allocations that are going to move the needle. So I think some probably overpromised and underdelivered, and it's going to be affected. Like you're not going to see you're going to see a drop off. And talking to bigger funds that were kind of doing that anecdotally, that's kind of the feeling that we're getting, and that it's like you kind of lose credibility in that sense whenever you're talking about how it's it's the future and this, that, and the other, which I still believe it is. You just oversold it, and I think it was kind of irresponsible. I get it why you did it from a marketing perspective, but ultimately, you're a fund manager. So you've got to be able to believe the things that are coming out of my mouth, because I'm managing your capital. So I'm always very worried about that. And I think sometimes like the lines get blurred between like marketing and actually, risk management or running the fund. So I think short term, yes, it's going to affect the narrative and it's going to affect institutional flows into the space. Medium to longer term, I think it's going to help it out a lot, because you're seeing pretty much the extent of how bad this kind of is and kind of how it could be if this keeps going the way that it is. And really the only solution that not funds, but central banks around the world are going to have to be able to do is just print and print and print. And ultimately that's going to move the needle. Do I think we're going to go back to full, we're going to remove fractional reserve banking and Bitcoin's going to, go on some sort of Bitcoin standard? No, I don't. But I do believe that we're gradually going to move more and more away from the dollar, because of what the central bank, what the Fed has to do to essentially prop up asset prices and potentially prop up the greater economy here as well. So I think gradually that's going to help. And then I wrote about it in one of the research reports that I did with Brave New Coin, essentially talking about safe havens, kind of like what we're discussing right now, is saying that a lot of the bad behavior of yield chasing that kind of help, push the bubble within equities, but also in private markets, like the private market premium, you're going to see a lot of that now, I anticipate, get recycled into digital assets potentially, because if you had unfunded liabilities of 80% or 70%, and now it's like 35% is covered because your investments took like a 50% haircut, you're sitting there looking like, okay, how can I fill this gap? So like the same exact yield chasing, risk seeking behavior, like, all right, how can I fill, like what's got the highest, risk reward profile? Bitcoin. Okay. Tell me about this Bitcoin thing. And like, you're even starting to hear some of like that commentary from Mike Novogratz of Galaxy, where he's like, I'm getting phone calls from people that I've never gotten phone calls before. And they're like, tell me about this Bitcoin thing. I don't think it's so much because they necessarily believe the store of value narrative just yet. I think ultimately it will grow into that. But I think it's like they're looking at, how do I plug the holes? And you look at Bitcoin, for all intents and purposes, it's not doing overly poorly this year. It's not filling its, it didn't really fill its store of value premise that a lot of people were pumping up it. But you look at it and you're like, all right, it was up 40%, approximately in January. Past 2 years, it's over 100%. If we could just get through like this downdraft and it stabilizes, like, okay, for sure, people are talking about this halving thing. It can go up another 100%, 200%. So then you start getting that sort of speculative mentality where you're like, I got to plug the holes. And I think that potentially is the next huge draft up. Like, again, at the beginning, I said, I think the next few years are going to be more reminiscent of the most recent years that we had. One caveat to that is if that narrative that I talked about comes to fruition, that's where you're going to see that leap from like, 10,000 to 100,000 or something even a little bit more. And it's because of now this speculative frenzy is being driven by like really deep pockets because they're like, crap, I've got to fill these unfunded liabilities like now because boomers aren't getting any younger.
Well, yeah, no, absolutely. I like actually, when the Black Thursday, as we call it, happened, Novogratz came out and he said that the confidence kind of got shattered in Bitcoin. He was kind of capitulating there a little bit. But it's like everybody, that narrative, everybody's trying to say that is kind of the hedge for the hyperinflation in the world and all that stuff. But we're seeing something different right now. From the, I guess, retail side, where what are some of the triggers that you would want to see? Let's say, okay, this is happening now, where like, okay, do we have to see maybe some countries like hit hyperinflation again, and people are just stuck as hostages in that like kind of bad economic times in their country, where there's limitation on like where they can get out of their currency into something else to hedge. Would we want, like, are we waiting for something like big, like, hyperinflation in Argentina or some of these countries that are experiencing all these economic issues to really kind of start saying, okay, wait, maybe we'll have some of the like smaller people, like retail guys that just, have some savings, right? And, instead of holding their currency that's just, dropping in value like crazy, and they can't get into a dollar per se because maybe of some restrictions that the economies will have to slow down the dump of their currency. Do you think maybe those guys that are savers will start getting into Bitcoin as a hedge for the hyperinflation for their currency in the country? And is that going to be like an indication of that demand that, people are saying that will come?
Yeah, so we're already starting to see a little bit of that, and it's tough to really like validate some of the data that you would see from some of these sites that track Bitcoin purchases through countries that have historically had bad monetary policy. But we're already kind of like seeing that if we can trust the data, and even if we discount it 50%, it's still meaningful, that some of the countries like Venezuela, Argentina, even Colombia, those countries that have had historically mismanaged monetary policy and weak fiat currency, they do look at Bitcoin as an alternative to holding their local currencies. So I anticipate that'll happen more and more, especially if this sort of like dollar squeeze continues to progress. So the countries that are going to get hit hardest from it are going to be emerging markets, just like you said. And I think that's why stablecoins, specifically ones that are pegged 1-to-1 to the dollar with, some backing of US dollar, Tether, not so much, haven't been overly transparent, but like USDC and stuff like that, where they actually will show that they have the reserves that they say, those are starting to grab the attention in the ire of the Financial Stability Board, because that's a perfect way for citizens living in Argentina or Venezuela to say, hey, I'm just gonna, I'm going to hold USDC rather than my local currency, rather than even Bitcoin. So I think it kind of goes both ways with Bitcoin and the stable coins as well. But I think the big thing that is going to move it to the next level is essentially us crossing the chasm. So I look at those countries that haven't had the good fortune of being born in the United States and having the world's reserve currency as their local currency. They are already like the early adopters. And now we need to cross the chasm to like the mainstream. And that is, countries in Europe or the US is going to be a big one. They're going to be the last one to jump given we have the reserve currency. But you need to see developed countries start saying, hey, this doesn't seem like this is responsible, or you start seeing demonstrable weakness in their local fiat currencies. I totally think that that could be a trend that will start picking up, and then that will drive the snowball that will probably eventually dethrone the US dollar. What of that will be, if it'll be like an SDR, a basket of currencies, or even a basket of hard currencies of gold and Bitcoin, a la Bitcoin standard, I don't know. But I think we need to cross the chasm for that to like really meaningfully get any traction.
Yeah, and it's a weird future to kind of predict or walk through, because depending on how quickly we cross that chasm and with what kind of degree of intensity, things could get really bad for a lot of people. Obviously, Bitcoin used as just a currency has its struggles. That was one of the first narratives that kind of emerged in Bitcoin being a great use case for payments. And while that still does exist, it's obviously not the one that people run with now. So yeah, it's a fascinating conversation to have. Obviously you're looking at the environment of crypto, and you're looking at Bitcoin and some of the other top kind of crypto assets that are out there. You're doing it in a data-driven way. But for those who obviously don't have the same data analytics background, maybe they just have some kind of what I would call part-time interest in crypto, but want to maybe make money on it or be involved in it, and want to continue to grow kind of their sophistication when it comes to looking at these various crypto assets. What can just one single individual do to maybe use data more to make decisions, or look at the market as a brand new asset class versus just looking at one individual token that has a lot of hype, essentially? And obviously, as is the case with our disclaimer, none of this is financial advice, so we'll get that out of the way.
So I think probably the biggest thing, like from a process perspective, is just like consistency, realizing that this is a bit of Wild West. So it's going to be a little crazy, but if you can, and there's definitely some open source materials that are out there, coin metrics, so you can go to blockchain.com and stuff like that, where it's easy for the layperson to sort of go there, or even just look at some of the pre-built graphics that they have built in there, and you can just start playing with it. If you don't have really any quant background, then try to look at the graphics of the chart to see, like, is there some structure here, and does it map to price, and has it mapped to price historically? Again, if you're able to do that, question yourself, because the biggest thing of this space that I see, especially from a data person, is everyone is constantly looking at history, and they're like, yep, this is going to happen because it happened the last 2 times. Like, halving's a big one. So again, this market is driven so much by narratives that I never roll it out, because it really moves markets how much people get infected with narratives in this asset class. But do I put a lot of grain of salt in any of this? Not at all, because the sample size is stupidly small. It's like, oh, well, it happened in the past 2 halvings. It's like, great, that's 2 times. So like, and you're going to bet your savings on this, or your investor savings on it in some particular capacity through there. So I would tell individuals, like, just explore. If you've got a little bit of a data background, like, just play around in Excel. If you don't, look at charts, see if you can map something that seems to hold up over time historically, and then gut check yourself. Maybe ask someone else, or just play devil's advocate with what you're seeing, and then gradually start to see how that might layer on to a strategy. Remember, you don't need to be, if you're right 51% of the time, and you can manage yourself or your asset allocations or your risk management appropriately, you're going to make money. So it's like, for us, I don't try to get every single trade right. I just want to make sure that the big ones we can get right, and especially the big ones on the downside, that we get those right as well. So it's like, I'll lose, the first couple percentage points so that I can get confirmation that like, oh, this is actually getting bad, so that we can get out. So I think having those three general primers might help the layperson like that's looking to get gradually involved with this particular space. It'll start building up, their foundation, and then they can gradually morph to their own specifications over the long term.
Yeah, I think that morphing or that evolution is a good way to put it and look at it too, right? I mean, because narratives are such a driver of price in the space. I mean, really, what a narrative is a thesis or belief, right? So I think people get attracted to crypto based on some belief of a Bitcoin standard or of a better financial future. That's how they kind of get infected, as you will, but you can't stop there, right? You have to have some sort of framework that you manage that thesis through, and then be able to use tools, whether they're around quantifying and qualifying data, or executing when the time is right to execute, right? You really have to think about it on kind of a multi-layered setup if you want to be successful in the long run. So, we've taken a good bit of your time here. We're running up, I think, a bit over an hour. We're at about 70 minutes now. We don't want to keep you for too long, but uncertainty, fear, greed, right? Kind of all the various things that are going on in the market right now are at all-time highs. I think there's quite a bit of uncertainty, not just in crypto, but in the broader economy as a whole. And Deem, I haven't forgotten. I'm going to let you touch on the oil markets as well before we let Chris go. But generally, as you survey the crypto markets with everything that's happened, and the kind of inbound recession that seems to be coming in the general economy, how are you kind of broadly thinking about crypto fitting in or not fitting in, or do you just not really pay too much attention to that because you are more data driven?
So I think about it from a high level, because I do want to see that, or at least I want to, again, like you talked about, have a hypothesis that it will fit in the long run in some frame or fashion. So I do believe that's the case. Obviously, I spoke about how I think over the longer term, it will evolve into some hybrid store of value, and that will ultimately attract more and more bigger institutions into the space, not just Bitcoin, but also, some of the different assets down the line, not just in the top 10 as well. So I do think longer term, it has a place in the overall macro economy. I mean, we're so early. I don't even think we're in the 1990s in terms of like talking about the internet bubble. I think we're even pre that. It's really early, which gives false starts like we're seeing, but also it can be exciting as well, given we haven't even scratched the surface potentially of stuff that we even thought about that this could problems that it could potentially solve. So I think it does fit in, but so that's like Chris. But as the fund manager, we don't care.
Right.
As long as we're on the right side of the trade, we don't care, and we'll let our models, we'll let our data dictate that. So I want the market to succeed in the long run, given I've staked my career on it, and ultimately I think it will. I'll revise the hypothesis as I get more and more data. But as far as fund management making money, we don't care as long as we're on the right side.
Yeah, absolutely. So let's touch a little bit on oil before we wrap up. Obviously,
Sure.
it's making the headlines, and at least Bitcoin didn't drop 300% in one day, so that's good. But it's crazy actually how you could have been short oil and you still lose money in that area, which is insane. But yeah, so oil is obviously taking a huge hit, and due to economic, like global slowdown due to COVID and all the stuff that's happening, and there's oversupply of it. And we see the prices are being reflected right now in terms of demand. That's obviously not helping the economy in terms of us, rebounding. What are what's your kind of outlook on this, oil situation that's happening right now? There's obviously some countries that are going to be hurt more maybe than others. The ones that are maybe, their whole economy revolves around oil. So those guys are going to be in deep, trouble, and especially if they, pair that up with the outbreak with COVID, that's a pretty bad scenario. Like, what are your thoughts on oil, being where it's at right now and how it's impacting, it's going to impact the rest of the world?
So yeah, I'm far from like an oil expert, and I would always defer to those individuals. But I think the biggest alarm bell that it's ringing is just how bad the overall the global economy is. The fact that there seems to be substance behind it. It's not just like, oh, speculators, something like what happened with Bitcoin, where it started with something fundamental, and then speculators got a hold of it, and then it was just it was systematic issues within the infrastructure that caused the crash. It's like, you can't blame this on bots. You can blame some of it on bots for sure, but I think what's more alarming is there's a logic behind it, is that there's no place to store it, and there's storage costs associated with it. So it's like, you can't even sell this stuff right now because demand has essentially gone to zero around the world. So I'm not so worried about the oil price in and of itself. I'm worried about what it signifies for the overall economy and what that spillover effect is going to be. So, I mean, there's credit issues. So it signals that the economy might be way worse than people are actually think that it is. It's definitely way worse than the equity markets are reflecting. That means that consumers are going to be way worse off. So then you've got credit issues, and then oil. I can't remember the statistics, but I think the U.S. shale producers, they need oil price at like $50 or $60 a barrel just to break even. So it's like that corporate credit. How are you going to roll that over in a year or 2 years or 3 years, whenever that balloon payment comes due? Whenever, unless oil hits a huge rebound, over that time period, it's going to be really, really bad. So I think the probability that there being not some credit contagion is really low. Like, there's going to be credit contagion, which is going to infect the financial system, which is going to put us in another potentially systematic downfall. So that's what I'm really worried about. And then again, whenever the market isn't pricing things correctly, that's when you see panic. And, that's what is going to suck down the market again, but also suck down Bitcoin. So I look at it from like a human perspective, where I don't want to see people struggle, and there's going to be real hardships that are here. But also I look at it from the fund manager perspective. And again, we haven't made nearly as much money as we could have, but I can't really in good faith, even in our models aren't signaling it as well, that there's just a huge unknown over our head, and it's pointing, and like the asymmetry is not to the upside. The asymmetry is squarely to the downside. So we just can't like really pull the trigger. And luckily our models have really backed that. And I think it just speaks to this overall thing where people talk about, oh, why is it Bitcoin rallying? Or don't worry, Bitcoin's going to rally because, QE infinity. And I see people saying like, they went full Zimbabwe, it's going to be Weimar Germany. The people that espouse that don't know what they're talking about, because there's so much debt in the world. So again, I love economic history. Like, that was sort of my jam in my earlier years. But if people are really interesting, Irving Fisher in the 1930s was a bad speculator, but he made a really good economic paper. And it was, over-indebted theory of Great Depressions. Essentially, being over-indebted causes deflation, which causes depression. So everyone's talking about this, global inflation, hyperinflation, blah, blah, blah. The US has the reserve currency. And like, if you go through Ray Dalio's book, he sort of like highlights the 6 prerequisites you would need to like fall into a Weimar situation. The US has like 2 out of the 6. So it's probably not going to happen there. But furthermore, we've got the most debt in recorded history. So I think the risk is to the downside, like deflation. So under a harsh deflationary scenario, which oil is signaling, asset prices, all shapes and sizes, Bitcoin included, get sucked down. The question is, will the Federal Reserve and the US government have enough ammunition to be able to cushion the fall? People think so. So essentially, whenever people say I'm long gold or I'm long Bitcoin because the dollar is going to go down, they're essentially saying that we're in a deflationary situation that could spiral into a depression. And they think that, the Fed is going to print, and the fiscal government is going to do more and more stimulus. That is totally true, and that has historically been their playbook. And gold drops in the initial phases. 2008 was no different. Gold drops. Bitcoin will drop, but then it'll start recovering faster and it will outpace the S&P because of all the store value properties and printing money and the dollars essentially going down. I don't know if that's going to be the case this time, given the ammunition doesn't seem to be working nearly as much. And then you've got people talking about this shortage of dollars that has the potential to go there. So it's like, you can't have two things at once, at least from my understanding of history, to where like you can't have a strong dollar, but then like strong gold too, or strong Bitcoin. So it's like, if the dollar is going to strengthen because there's a shortage of it and we're going into a deflationary depression, that means real interest rates are going up and you get a dollar swelling. So your dollars purchase more of things that previously it couldn't. So that means that gold's going to go down and Bitcoin's going to go down. And the only way that reverses is if there's enough ammunition from policymakers to cushion it and then stabilize and then gradually start the process of growth, albeit artificial growth, similar to like what they did in the 08 and 09 situation. Do I think that can happen? For sure, but the probability is less nowadays, given we've essentially shot the bazooka for 08, 09, really never withdrew any of the stimulus. And if you just look at the Federal Reserve's balance sheet, it will tell you that we're probably in deep shit. So
on that note, yeah, go fill the bunker up. No, I mean, I think that's very valuable information. It's really a lesson to those who are listening to not take your economic advice from memes on Twitter, right? Because I think that the main push or kind of narrative or certainly meme going around is money printer go burr. And we haven't really seen any sort of real inflation in decades, right? The Fed has not been able to get the real inflation rate to the number that they wanted, right? So I've found it difficult to see that inflation scenario playing out in some sort of rapidly fast time frame where all of a sudden, as you said, the opposite effect happens where gold and Bitcoin go crazy through the roof. As we were talking about oil at the front of that question, at the front of your answer, basically what we've seen is kind of this Bermuda Triangle of disaster that happened with oil, where you've had oversupply for some time that's now been coupled with a giant demand shock as everybody's under stay-at-home guidance. Those two key pieces, alongside the expiration of the futures contract, just devolved into a complete collapse of oil. And taking that as an example and looking out on Bitcoin in the future, the thing that I struggle to kind of foresee when it comes to a bullish scenario for Bitcoin is that if you take that same Bermuda Triangle and you overlay retail and institutional demand as one piece, or one corner of the triangle, you overlay supply right around the block reward, right, and essentially new Bitcoin that could be hitting the market, and then overlay really is the third piece as well, the price. In a lot of ways, it's tough to see how demand kind of overexerts itself on supply when, as we've said, the institutional narrative is kind of broken. And, if it's on the traditional side, they have many more problems that are much bigger to deal with versus thinking about, hey, is Bitcoin going to become, the devil that kills all of fiat currency, right? And on the retail side, right, if we go into a period where 15, 20, even 25% unemployment in the US is a standard for a little while, where does the excess cash come from on kind of the more of the retail buy and hold side? So, my biggest kind of fear or uncertainty is that third corner, right? That what is kind of the futures contract expiration that could be a very negative event for Bitcoin. BitMEX and that whole kind of liquidation spiral that happened, that was very similar. So maybe we already had it, right? And things kind of just chop along and consolidate and whatnot. We don't see lower levels, but the fact that demand is low, we're going to see quite a bit of minor sell pressure, I think, with the price being under what will be, a break-even point for miners on every Bitcoin that they that they're able to produce, unless, we pop above 10K here, obviously. That's kind of my uncertainty, right? Is what's that third corner of the triangle that's going to negatively affect Bitcoin, but it could also positively affect it, right? If some government comes out, to Dimitri's point, and says, hey, we're out of options, we're going to base this brand new digital currency on a basket of other fiat currencies, gold and Bitcoin. Now the narrative is kind of further strengthening, and that rush to the exchanges from all parties happens, and you do see a lot of that demand come. So it's a wild world, and who knows kind of where we go from here, I guess.
No, I totally agree. And it's like the caveat I would just give to people listening. It's like, hey, don't take what I'm saying, at face value either. It's like, yes, I'm studied and well-read, but ultimately, like, do your own research and preferably do it from third-party resources that have no vested interest. So it's like, even me, I'm trying to be as dispassionate as possible, but obviously I have a vested interest. So it's like, there's tons of great books out there for people to be able to do research and then see whether or not it maps some frame or reference to what's going on in the current day. Today's really unique, but you can kind of piece together some of the different economic lessons of history that might be able to help out. But yeah, I don't know what the third shoes is going to drop, and I could be totally wrong. I mean, the Fed could say not only could unlimited, and then their balance sheet grows another 6 trillion, and then Trump or the next president comes in and says, hey, we're doing universal basic income, it's going to cost us $10 trillion over the next 5 years or whatnot, and it's like $3,000 a month or whatever it is. We've got the world's reserve currency. So long term, like, for sure, we're going to lose it because we're abusing the power. But like, who knows? Like, that could be enough, and we stave off potentially the biggest depression in recorded history at the expense of losing the global reserve currency and allowing China to now come up and be our equal, because China is just going to keep budging in, and they're not wasting a crisis. So they're using it to try to gradually, move in more of the geopolitical power to the east versus the west. So it's like, again, there's no free lunch, but under those guises, that might be a better scenario, albeit if it doesn't end up in war, which is a historical imperative as well, where the incumbent power typically wages war with the upcoming power. As long as that doesn't happen, that might be a better alternative for everyone, because Bitcoin and gold can go up. Maybe we get to some partial pegging of a fiat currency to reduce this, profligate nature of what's been going on for the past 50 years, essentially since Reagan took office. And we don't have to have this like huge depression where we know the statistics as to how that's going to affect people. But again, I don't know anything. I always posit that to people. I tell them in quite blank words. It's like, hey, I don't know shit. So I just, I tend to validate what I say by data, but, people listening at home should definitely do their own research and just like piece together their own mosaic that might make sense to them.
Yeah. It's that creativity. It's that research. It's that perspective that kind of ignites new thesis and new ideas in general. So yeah, I'm right there with you. Right. I like what Joe Rogan says on his podcast. He's like, don't listen to me, I'm a moron. That's the same here. None of us are oil experts. None of us are, economists or anything of the sort. We like to talk crypto, and regardless of what happens, many of these days will go down in the history books from a financial standpoint, an economic standpoint. And that brings us to our last question, which we ask every guest, which is, if you had one book, any book, doesn't have to be crypto or data related, any book at all, as a recommendation, what would that book recommendation be?
I would probably do Lords of Finance. It's sort of like a history of central banks, going through some of the more interesting times. I believe it starts with World War I, and then eventually in the lead up to World War II, and then eventually World War II as well. So that's readily available. And another one I would just say is Ray Dalio's book on essentially picking up where Irvin Fisher left off, talking about, whenever over indebtedness leads to bad outcomes, whether that's a Weimar type situation, which is from, the leftovers of World War I, or you get to a Great Depression or a great financial crisis. The case studies version of that is something that I have in my library right now. In all honesty, it was something that allowed me to be ahead of the curve whenever all this started taking center stage. Admittedly, I was a naysayer at the beginning. I kind of despise crypto Twitter in a lot of ways. So whenever I saw a lot of the people that were pontificating, I just kind of, wrote it off. But some of them turned out to be actually, fairly clairvoyant. But what allowed me to get back up to speed more quickly was that book. And I was like, oh, this seems like something's different. And even talking to some like grizzled veterans who were trading on Wall Street during 2008 and even before then, they didn't see it coming because they essentially been in good times for the past, 10 plus years. So I think those two books are probably now more relevant than ever, especially if you find yourself like constantly swimming in a sea of news and you're like, what the heck is happening?
Beautiful, beautiful. Well, this has been a fantastic episode. Thanks again for the time, Chris. We'll be sure to have you on here in the coming months as hopefully things settle down and we don't see further price decline in any asset. But again, thanks for the time.
For sure. Thank you, gentlemen.
Thanks a lot, Chris.
Hey guys, we hope you enjoyed today's episode. Make sure to check out Layer 1 on all the audio and video platforms listed in the description. Thanks for stopping by, and we'll see you next week.